All right, let's talk about it. Growth or dividends. It is the classic investor showdown, right? Are you on team high flyer, going for those massive gains? Or are you team slow and steady, collecting those income checks? It always feels like you have to pick a side. Well, today, we're going to dive deep into this debate and maybe, just maybe, discover that the question we've all been asking isn't even the right one. But this isn't just about numbers on a spreadsheet. As this comment from a Reddit discussion points out so perfectly, there's something deeply psychological going on here. For a lot of people, that dividend check, it feels like a reward. It feels like free money just showing up in your account. But is it? That feeling is really at the heart of this entire debate.
So let's really frame this up. Let's meet our contenders. In one corner, you've got the explosive, high-octane potential of growth stocks. And in the other, you have the steady, reliable income from dividend stocks. For so many investors, especially when you're starting out, it feels like an either-or choice. Okay, first up, let's really dig into the powerful, compelling case for going all in on growth. This is the strategy that many people believe is the absolute best path for investors who've got time on their side. So, according to Financial Samurai, the logic here is actually pretty simple. If you're under 40 and you're still earning a salary from your job, you really don't need another source of taxable income from dividends, right? Your number one goal should be capital appreciation. That means growing your nest egg as big as you can, as fast as you can. It's all about getting to financial independence sooner rather than later. And I mean, just look at this. This is a real-world comparison that just lays it all out there. The difference is absolutely staggering. You've got a growth stock like Tesla delivering these mind-blowing gains, while a dividend favorite, AT&T, actually lost value over the same period. This just perfectly highlights the incredible, almost lottery ticket-like upside of growth investing. And this quote just nails the growth investor's mindset. Let's be real, the stock market is risky. So if you're going to take that risk, the argument is you should be rewarded for it with the highest possible return. You're not in it for a tiny 2 or 3% dividend yield. No way. You're hunting for the big wins, the stocks that can literally change your financial future. You're not playing for crumbs. So, when you boil it all down, the case for growth is all about potential. When you have a long time horizon, you can ride out the crazy market swings and just let these innovative companies reinvest their earnings to fuel even more growth. You're aiming for that beautiful, powerful compounding effect.
Okay, the case for growth is strong. It's really strong. But if it's that simple, you gotta ask, why doesn't everyone just do that? So now, let's flip the coin and look at the other side, the very real allure of dividends. Seriously, why would anyone turn down that incredible potential we just saw? Well, it turns out there are some very compelling reasons why millions of investors, both young and old, choose to focus on income. And it's about more than just that psychological comfort blanket we talked about. You see, dividend stocks offer a totally different kind of value. They give you a predictable, reliable income stream, which, is absolutely vital for retirees. The companies that pay them are often these stable, established giants, so their stocks tend to be way less volatile. And think about it. In a scary market crash, that steady dividend payment can feel like a lifeline. It gives you cash and, maybe more importantly, the confidence to stay invested. Okay, but we have to tackle that free money idea head on. It's so seductive, but when that dividend payment actually lands in your account, where does that cash come from? The financial reality of it might actually surprise you.
Here's the deal. A dividend is just the company taking cash out of its own bank account and giving it to you, the shareholder. That's it. So when that happens, the company's total value, its stock price, drops by pretty much the exact amount of cash it just paid out. It's not magic. It's just a transfer of value. It's like taking $1 from your left pocket and putting it in your right pocket. It's still your dollar. It's just in a different spot now.
And, understanding that dividends aren't free money, that's the key. That unlocks everything because it lets us completely reframe this whole debate. Maybe the real answer isn't about choosing a side at all. And this brings us to the most important concept in this entire conversation, total return. This right here is the game changer. It's a strategy that stops looking at growth and dividends as separate things and instead combines them to see the full picture of how an investment is actually performing. And this is it. It's a simple little equation, but it is so incredibly powerful. The growth in your stock's price, that's your capital gains, plus the dividends you receive, that equals your total return. The two sides of this big debate, they're just two parts of the same single number that truly matters.
And hey, don't you dare underestimate the power of those dividends. If you look back historically, they've actually made up nearly a third, a full 32% of the S&P 500's total return. That is a huge slice of the pie. It proves that income is a critical engine for long-term wealth creation. So, this is where we land. We've arrived at the resolution. The whole debate was framed incorrectly from the very start. It's not about choosing growth versus dividends. The real goal for any investor is to maximize your total return. And that means finding the right combination of both capital appreciation and income that works for you. So, the big question is, how do you actually apply this to your own portfolio? Well, it all comes down to finding the right strategy that fits your unique situation, your unique life. Your ideal mix of growth and dividends really depends on a few key things. How much time do you have? How much risk can you stomach? What are your actual financial goals? And yeah, you even have to think about your tax situation. These personal factors are what shape your perfect custom-built strategy. And here's a fantastic example from Financial Samurai that shows what this might look like in practice. Think of it like a sliding scale. When you're young, yeah, you might go 100% into growth. But as you get older, you gradually, slowly shift that balance more and more toward income-producing stocks to get yourself ready for retirement. So, we end up right back where we started, but with a totally new perspective. The great debate. It was never about picking a side. It's about finding your personal balance. By shifting your focus away from either or and towards what is the right mix for me, you can start building a truly powerful strategy that's designed to help you reach your own financial goals.